Welcome to the Best of Investing. I'm Edward Brown, your host. Here's our format. A bunch of guys sitting around a bar. There's no bar. Having drinks. There's no drinks either. But we're talking business, and you, the audience, are listening in. The Best of Investing is actually a radio show that has been around since August 2010, and it airs every Saturday on Fox News Radio, 9:10 a.m. at 1 p.m. Now, we're not a political show. We're strictly business, so everyone will be happy with that. Remember, I'm Edward Brown, wishing you the best of investing. Are you ready? Let's go. We have in the studio with us Peter Lagarias, who is a specialist with class action suits, or actually that's what we're going to be talking about today. So Mark, you were going to lead in with questions.
Yeah, we had, we talked last segment about how, oftentimes these class action suits are against large companies, and oftentimes it's for maybe an overcharging of a fee, and the payoff to the individual client's usually not that much. But can you give us some examples of class action suits where the payoffs were considerable to the participants?
Well, a good example is a group of Exxon franchisees filed a lawsuit regarding price conduct. They were getting gasoline and there were other charges involved, and that case actually was a class action that was tried in a court of law. It didn't settle, and it was enormous amounts of money because of the volume of transactions going on in a franchisee dealership.
How many franchisees were there?
I don't remember. You're putting me on the
spot
for the number.
But it can't be millions. I mean,
no. There were probably thousands, but I'm not even certain of that. But there were many franchisees, and it was a class, and it went to trial. Wage and hour and misclassification of overtime.
Oh, right, we read about those quite often.
And those can be substantial. There was a class that was certified for discrimination against women in the Walmart system that went all the way to the Supreme Court, and they turned it down for class certification.
Really?
And that was going to involve many women that were employed by Walmart, but ultimately the Supreme Court declined to certify it.
Well, and I'm just thinking this is the perception. Okay, I'm not saying this is my perception, but I think the perception is that class action attorneys are sort of out there like ambulance chasers looking for these kinds of cases, rather than a situation where, like the Exxon case, where you have a plaintiff coming and saying, look, I know this is wrong, and how much would it cost each franchisee to hire his own attorney for basically the same kind of claim, right?
Well, where is the outrage for the corporations spending all the money to defend?
That's a good point.
Right, those could be profits to shareholders.
Well, but the fact is that the defendants in these cases are paying the lawyers all along, and nobody seems to be outraged with those lawyers.
Yeah, but they're not the ones who are starting it, though, right? Someone's bringing them a case where suddenly they now have to hire attorneys.
Well, should individuals in the United States of America be entitled to file lawsuits if they've been aggrieved? And the answer ought to be yes.
Yeah.
And will some lawsuits be filed that aren't meritorious? Yes.
But that happens whether it's a class action or not.
Exactly.
I mean, it's economies of scale.
It is a good word to use with class actions, and in fact, as a matter of legal theory, the courts would be swamped if you have a class of 1 million people that had this credit card transactions, and they were all bringing their individual lawsuits. The courts could not handle it.
Well, that brings me to the most recent case that has been in the news, and this has to do with Honda. And there is a woman who's deciding not to join the class action suit, and basically the suit has to do with mileage. Apparently she bought the car thinking she was going to get 50 or 60 miles to the gallon because it's a hybrid, and apparently it's being determined that she's only getting about 30 miles per gallon.
That's a big difference.
That's a pretty good size difference, and I guess they're trying to prove that Honda's to blame for this. So there's a class action suit going on, and she's deciding that she happens to be coincidentally an attorney, but she's not acting as an attorney. In this case, she's acting as just a plaintiff. And she's deciding that it's better for her, because I guess the dollar amount involved, to go to small claims court, which is now up to $10,000. So I was going to ask Peter on this, like, at what point does one decide, no, I want to do a small claims court on my own case? Because here was one of the advantages that she thought was the fact that in small claims court, the defense, or neither one actually, gets to have lawyers in the courtroom. So Honda, if they respond to this or don't respond, they're going to need to have some employee who's not an attorney represent them. So, how does one decide, like, what's...
Well, an individual going to an attorney seeking representation has to present their case, and during a discussion with the attorney, it may come up. The individual may think about a class action on their own, or they may ask the attorney about it, or the attorney may find out, well, are there other people that this is happening to help prove the case, and it may come out. Bringing a class action requires an individual to be the named class representative, and sometimes more than one will be named. And that person has special duties because they're not just bringing the case for themselves, but they're bringing it on behalf of a class.
And as a potential claimant, you can opt out. I mean, not everybody has to be part of the lawsuit. Like this lady, she's saying, no, I'm going to opt out and do my own case.
Yeah.
So at least she has the choice.
That is correct. When a class is certified, the court will notify all of the class members, and there's an issue about who pays for that, but it's typically done by a postcard or something like that. And individuals can make a decision. And they can decide, I don't want to be part of this class. Now, there's some other exceptions to this rule. In some instances, you're automatically included unless you opt out. But in most cases, you're not. You need to make this decision
To actually opt in.
So you get that thing in the mail where you're supposed to take some kind of action. It tells you.
It tells you you have a period of time to opt out.
Yeah.
I mean, I guess that's kind of the best of both worlds, because then at least it's up to the individual person.
Mm-hmm.
They may say, you know what, if I do have a claim here, okay, I'll take it on myself and try to figure out who to sue, which is usually kind of hard to do. Mark, do you have any last minute questions?
Yeah, well, I have one that like a class action that actually kind of hit home for me. I'm a member of a timeshare, and that timeshare did a special assessment in addition to the rather expensive annual maintenance fees that you pay, like nearly $1,000 for most decent timeshares. And we got this bill in the mail for a special assessment for $2,000, which we didn't pay, and apparently a lot of others didn't pay either. And a group apparently got together, and they were able to put a class, obviously large enough, but not a big class, certainly not involving thousands or millions of people, but they successfully sued in California this vacation club. And it was determined that those special assessments were not legal. So that was there was an example of a relatively small group of people getting together and successfully suing in a class.
Well, and actually in that case, rather than the typical situation where you're the plaintiffs trying to extract money, you guys were the defendants.
Yeah.
Trying to not pay.
Well, if they were sued, they were defendants. They may have filed what we call a declaratory relief action.
Okay, you're getting
Right.
a little bit too particular here. I'm a layman, remember. I get to use these terms, but... Welcome, you're listening to the Best of Investing on News Talk 910, sponsored by Pacific Trade Exchange, your best in exchange trade. Check them out at pacifictradeexchange.com. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. For those of you listening for the first time, here is our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience, listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Robert Schiff of RPM Mortgage. Our phone number is 888-912-1190. Now write that number down, 888 912-1190 because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. The vacations are sponsored by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses. Their website is lighthouse4fun.com. You can reach them at 916-777-5511. And today's trivia theme is men who played women or vice versa in the movies. And you'll understand.
Where do you get these terms?
People send them to me. I don't know. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And we're also on television now. Comcast Channel 26 on Saturdays at noon and Sundays at 6 p.m. Don't forget to also record our show on a website called dar.fm. And a couple of housekeeping items here. Quick reminder again, World Wraps in Corte Madera and Santa Clara is still giving our listeners a free smoothie with purchase of a wrapper bowl. If you mention the Best of Investing, go there for lunch today. Best wraps in town. And don't forget to mention the Best of Investing for your free smoothie. Also, a few weeks ago, we had Stefan Piscano on our show, and his website, realbay.com, is now up and running. So check them out for free online real estate auctions. Now, today we have an extra special guest. His name is Peter Lacour, and I've known him for many, many years, and he's going to be discussing municipal bonds with us because he is the muni bond expert. Peter,
Awesome.
Welcome to the Best of Investing.
Thanks, Edward. Great to be here.
Okay, good. Go ahead and just come right in and tell us, quick definition, what are muni bonds?
Well, I'm going to do a little municipal bond 101 here, just to start off. What is a muni? A municipal bond is a debt obligation. It's a lot like a mortgage. It's issued by a state, a county, a city, and they do that to raise money to fund projects for the public good. That would include police stations, fire stations, freeways, sewer and water, et cetera, et cetera. Some of the nuts and bolts of muni bonds, bond issues are as small as $1 million, or they can be well over a couple of billion. California general obligations, very large. They have a fixed rate of pay, a fixed maturity date. They're sold in multiples of $5,000. But the biggest thing with munis, by far, the most important characteristic is they're tax-free. So people buy municipal bonds for their relative safety.
Okay, and you
Not to say relative nowadays.
Yeah, that's right. What are the yields that we're looking at for California munis?
On the short term, probably 2 to 3% on, say, 5, 6, 7 years, in that range. 4 to 5 tax-free on longer term bonds, and 6 to 8% in the high yield market, which those would include tobacco bonds, which are pretty fascinating little sector of the
Tobacco
market.
bonds, really?
Yeah,
Yeah, people react just like that with tobacco. Yeah, so.
exactly.
What is a tobacco bond?
So what are they?
Yeah.
Well, actually, tobacco bonds came to being in the 1990s when we had all the litigation going on. Remember Marlboro Lights and constant lawsuits?
Sure.
Oh, right, the settlement, right?
Yeah, it was called an MSA agreement, the Master Settlement Agreement, in 1998. This is when Big Tobacco settled the ongoing lawsuits with all of the states. It was pretty fascinating, actually, and the deal was Big Tobacco, and Big Tobacco would be like Altria, Philip Morris, R.J. Reynolds, which is
Sure.
Reynolds America right now. These are excellent companies, actually. Altria is a $64 billion market cap company, pays a 6% dividend. So these are companies that are in high-grade equity portfolios.
And plus, one of them makes Purina cat chow, right?
Yeah, exactly.
Okay.
But so you're not talking corporate bonds, though. You're saying that that's a type of muni bond?
No, this was part of, to go on with the story,
Tobacco, yeah.
Yeah.
they had this settlement. So in order to settle anybody who produces tobaccos, i.e. Altria, had to kick money into a pot, so to speak, and then those monies are doled out to the states on a pro rata basis. So depending on how many cigarettes you produce, you put that many money in the pot. That's divided up and paid to the states. So what did the states do almost immediately? They have this income coming in. Well, with all the fiscal budgets, everybody needs money. They're like,
borrowed
hey,
against it, didn't
well,
they?
you know what we're going to do is we're going to
Borrow against an annuity, okay.
Yeah, exactly.
That
we
makes
want
sense.
our money up front, so they floated issued bond issues that are secured by the revenue stream from these tobacco
So
players.
it's as safe as the tobacco
Exactly.
companies
That's
putting
why
in.
that's why I'm mentioning Altria and the
So
quality
keep
of these
smoking
companies.
and keep our kids in school.
Exactly.
Well, some of these companies probably do a lot more than just tobacco, and that may be a minor percentage of their total work.
Absolutely. Well, the strength of the revenue stream, which is key, is just the quality of those companies. So the states go ahead and float these bond issues, and so in the late 90s, you had all these bonds come to market. There's currently about $40 billion of tobacco securitization is exactly what they're called. And
Let me ask you, what's the yield on that kind of bond right now?
well, when they came out, they were about 5 to 6%. And then what we've seen over the past decade or so is they've gotten cheaper for a number of reasons. One, supply and demand. There's 40 billion of them. That's a lot of bonds out there. Two, there's kind of a negative stigma with the bonds
Sure.
because you say the word tobacco and I don't want any tobacco, anything to do with tobacco.
Yeah.
When actually they're almost, you could look at them as an anti-tobacco bond.
Yeah, because
Right, exactly.
Yeah,
Now, are those bonds rated? Are they just rated?
When they came out, they were investment grade. So investment grade is going to be BAA up to AAA. These were BAA. Recently, they've been downgraded below. That's another reason why they're trading a little
Hence
bit
the higher
cheaper.
yield.
So,
Okay.
yeah, what is the yield right now on an average?
Currently, the tobacco market trades probably between 7 and 8% tax-free.
Wow,
So-
both federal and California
That's
tax free?
Absolutely.
Now, are the tobacco companies' balance sheets safe enough right now? Are they paying? So far, you've
yeah,
seen?
absolutely.
I mean, in other words, they haven't missed any payments, have they?
No, absolutely not.
Okay.
Well, one of the reasons why they're cheaper, as I said, one, the word tobacco, and people shy away from them. There's a lot of the bonds out there. And also, it's tied to the consumption of tobacco. Now, that was part of the agreement, the settlement. They figured declining smoking rates,
Yeah.
but they've actually declined even a little bit more.
Well, I know you were going to ask a question about bankruptcy.
Yeah. Peter, bankruptcy has been big in the news as a muni bond risk in the last couple of years. How is that faring right now? Is there a lesser risk, or is there? Well, what's the perception there for muni bond bankruptcies?
Well, when it comes, first of all, Stockton has been in the news. That's what we've seen lately.
Yes.
And people definitely jump at that headline news, and that's it's the proverbial throwing away the baby with the bathwater. You really shouldn't jump when you see chatter about bankruptcy. We saw that actually with a very famous analyst, Meredith Whitney, came out a year and a half ago or so, talking about potentially multiple bankruptcies all across the nation. And that actually hasn't happened. But if you look at it, for instance, take Stockton. Stockton doesn't want to, they're not in a rush to go file bankruptcy, which, by the way, is Chapter 9. It's kind of an odd, it's not 7-11 or 13, it's a municipal Chapter 9 filing. There's only been a few hundred in the history of the country.
Which we're going to get into the trivia on munis when we come back from break, because he's got a couple of interesting trivia questions that are kind of fun. So
Great.
we're going to have to go to commercial break right now. When we come back, we're in the studio with Peter Lacour, who's an expert in municipal bonds, who's going to be feeding us all this great information. And here is our first trivia question, and it has to do, again, the theme is men who played women or vice versa in the movies, all right? Dustin Hoffman played a woman in this 1982 movie. What was the name of the movie? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Dustin Hoffman played a woman in this 1982 movie. What was the name of the movie?
Why am I thinking chocolate?
Chocolate? No.
It's related.
It's related, yeah, really. You're cheating. Okay. And call 888-912-1190. Make sure to include your name, your email address, and speak slowly and spell out each letter of your email address, and we will be right back.
Awesome.
Excellent.
No,
Okay.
That's
quick.
perfect.
That was
That's a
that
quick
was
segment,
smooth.
and it went
Yeah.
good. You were great,
Well,
Pete.
See? Nice and simple, huh?
Piece of cake.
So we forgot to
That
get into
didn't
the
feel like
We said
2
some cool-
hours, did it? It went quick.
Oh, yeah, so
goes-
let's take off our heads off.
It goes so much faster than
Commercial
you
break
think it
you've
will.
got.
Yeah.
Got another little sticker here for you, my friend.
Oh, let's see.
It's just like I'm supposed to do a
This is what we
6-minute
have today.
presentation
Yeah.
at this
What do we
conference
have
call next
today?
Friday. So I write this whole thing out and then I speak it. It's
We
like
get
12
any
minutes long. It's like, I thought it was going to be like half.
Oh,
You know,
wonderful.
things always take
Edward's
longer
right.
You like that?
Yeah.
than you think.
I like when you rip it off, though.
Oh, yeah, well, I'll do, okay, ready?
Pain. Yeah.
Ah! You know, that's why I have a bald spot right here.
Yeah, you only rip off half.
I know, it always comes out like that. You need some filler time.
Yeah.
Oh,
Filler time.
No, seriously, he and I go
So-
back to kindergarten.
Yeah.
You know that?
wow. Now, where
You
was
haven't
this?
changed a bit either.
No.
You were big back then, too.
And where was this?
And I was invited out onto a yacht, and I looked over, and there was
Oh, how
this
exciting.
supermodel on the yacht next to me, and now I can't remember her name. She was hanging out.
Couldn't have been that super if you can't remember her name.
Oh, you know, when I.
You remembered how she looked.
Yeah, that part you never forget. You guys ready?
Hit it.
Let's hit it.
My low tech timer.
You know what that comes from?
Hit it.
Yeah. Where does it come from?
Is that Animal House?
Yes, very good. Otis Day and the Nights.
That's
Just
right.
let's hit it.
Yeah, that's right.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money, Robert Schiff of RPM Mortgage, and Peter Lacour of Securities America. When we cut to the first commercial break, we asked this first trivia question. Dustin Hoffman played a woman in this 1982 movie. What was the name of the movie? People?
Tootsie.
Exactly. Very good. All right, Peter, we know that you had some great trivia about munis. Go ahead and share that with us.
Okay, I don't know if it's that great, but there
Oh,
are
it's
three
okay.
little nuggets here we can shoot out here. The first one is, what was the first municipal debt?
Anyone?
Oh.
That would be
See.
globally.
Oh, globally, let's see.
Ancient Greece.
Yeah.
That's close.
Tiberius. I
Rome.
think was when,
Whoa! Rome,
Yeah.
Rome's the
they wanted
winner.
to build. They wanted to build the
Noah building the ark.
Yeah.
building a harbor.
Yeah.
Rome wanted a harbor.
The
They
first-
floated a bond.
They-
for it.
The first municipal debt was the Renaissance Italy, circa 1500 or so, where the Italian city-states borrowed money from the wealthy banking families.
So it wasn't Da Vinci wanting to build his first airplane.
I think it was to refurbish
Okay.
the Colosseum.
The refurbished the Colosseum. Okay, next trivia.
Next one was was the first U.S. Municipal bond on record, and that
Municipal bond.
It wasn't.
Wasn't the Revolutionary War bond.
I mean, you would think that would be it.
1812, New York City general obligation for a canal water project. So-
That was
It's actually
before.
not
That
that
was
long
before
ago.
the British attacked, I guess.
Yeah, for the War of 1812. Yes. Next
And then
trivia.
the last one is the first widespread municipal financing on a real major basis. I'll just go ahead and say this one was for the railroad systems all across the U.S.
That makes sense.
So that was a
Okay. Now, you told me earlier, and these guys haven't heard it yet, the story about the bag lady. Share that with the audience.
yeah. I had a funny story. A good friend of mine owned a bond brokerage, as a matter of fact, here in Larkspur, and he told a story about the bag lady who strolled in his office. You know, an elderly woman. She was kind of disheveled and certainly quite odorous,
Odorous.
and so
She smelled.
she smelled, and she was staggered in and had this big, giant, Glad green bag, and it was full of something, and he was kind of curious of what that might be in there. So anyway, he rushed over. Can I help you? Information? What do you need? You need the restroom? Can I give you a lift? And she looked at him and said, "Yeah, you can give me a lift. You can lift this big bag over here on your desk." Where she plopped it out and emptied over $1 million of bearer bonds.
Oh my
Oh.
God.
And bearer bonds are.
Bearer bonds are securities with no identification. So if you're walking around with a bearer bond,
Just
don't
like
go in a
cash.
dark alley
Yeah,
and get
it's
mugged.
As good as
because
gold, right? Highly liquid.
It's ready to go.
Okay. And I know Robert wanted to ask a question about interest. or
We're
inflation.
in an environment right now where there's very low inflation, and how does the rate of inflation affect the bonds?
Well, as far as low rates and when they do eventually go up, they're cyclical and they're going to go up. Or really, what you want to look at is how you can hedge against that, against rising rates and bond portfolios taking a hit. And the easiest way is just to shorten up on the maturities. You can ladder your bonds when you buy them so that constantly you have different blocks coming due and rolling over into the new higher interest rate environment. There's also plenty of ETFs nowadays. TBT is one that is short treasuries.
Wait, hold on, Mark's got a question.
What's an ETF?
Exchange traded funds. They're actually
Almost like a mutual fund, right?
Exactly. Yeah, they're
okay.
very plentiful now. It's becoming a much bigger market. They're not quite fully efficient, frankly. So you have to watch that. But if a person has a large bond portfolio, there's lots of different ways you could hedge it. You know, buy gold. So we'll see. And plus, rates aren't going to go up overnight. We just had the Fed a couple of days ago said we're talking 2014 before rates possibly would rise. A couple of the fellows in said 2016.
Wow.
And even when the Fed meets 7 times a year, so even if they were to raise rates consecutively, you might be looking at 200 basis points, 2 percentage points higher.
Yeah, because they
that'd be
usually
3 or 4 years
quarter to
out.
half
So
a point, they don't do too much.
and who can predict anyway? Actually, I heard a quick joke. I actually heard this from Mitt Romney the other day.
Okay.
It was kind of interesting. He quoted Yogi Berra, and I'm a big baseball guy.
Yeah.
They were. He was talking about predictions, and Yogi said, "I hate making predictions, especially when it has to do with the future."
That's right, exactly. Hey, do you have a favorite bond right now? Anyone you specifically like?
A good quality bond, ones that right in the 5 to 5.5% level that doesn't have delinquencies. I mean, you're looking at quality right now. It's the utmost thing. As we haven't got into the bond insurers, but the bond insurers have all pretty much gone down the tank. So when you're looking at a bond, you're looking at the underlying rating, which means the standalone rating, and that's what matters. So actually, there's so many bonds out there.
Well, I remember that with the insurance. It used to be that, we could tout that we had insurance for the bond, but now the insurance companies had problems, didn't they?
They had big problems. The insurance companies made all kinds of money just going about their vanilla business of insuring municipals. What happened was the other side of the business is their securities portfolio, and that typically insurers keep short-term money, T-bills, nice safe stuff. But to keep up with the Joneses or keep up with the Browns, for you, Edward, they started getting into, I kind of call it the crazy paper. They started getting into what turned out the subprime mortgage paper, and also kind of made a spicy stew. They added derivatives and credit default swaps, which I won't bore the audience with.
Mark, that's your favorite thing, credit default swaps. I order that for lunch every day.
It's spicy.
So anyway, these bond insurers who are making great money just insuring municipals straight on basically tanked their businesses on the side by getting into all this paper that blew up. This is basically the paper that was at the center of the whole meltdown that we just experienced.
Sure.
So these insurers that used to Standard & Poor's, which we'll save that for another day, the rating services, would rubber stamp them AAA. The insurers were either bankrupt or a lot of them are, say, B- rated or something. And when you're in the insurance business, you're as good as your rating. If you're in insurance business
sure.
and, hey, I got a B rating over here, it's no good. So it's key right now. In fact, when you look at ratings on bonds, they'll have one column that kind of has the standard ratings that every bond people are used to looking at. And then on the other side now, it's called the underlying ratings, and that has to do on standalone strength of the municipal itself. So in a way, it's kind of good. It's kind of washed out, any of the questions. So when you look at a bond, the underlying rating means exactly what's going on with the bond and what's its strength as far as paying its bills.
Yeah, rather than just looking at any old bond and just going, oh, well, that's okay, don't worry about it. You got a big insurance behind it.
Or the rating was done by a company that has their hands on both sides of it, so
Yeah,
the rating
yeah.
might have been.
Well, that's
so-
a real interesting thing, because the ratings, Standard & Poor's and Moody's, and not, they're great people there, but these people were exactly the ones that rubber stamped AAA on all the crazy paper I just mentioned,
Yeah.
all of the derivative nightmare paper that was out there. They said it was AAA. I remember 60 Minutes a couple years ago did a piece, and they were interviewing some mayor in Iceland or wherever it was, and she was, well, it was the U.S. mortgage paper, AAA, and
Sure.
and
Well, I remember years
so these
ago-
rating services, you take it with a grain of salt.
Well, I remember, talking to municipal bond brokers years ago who said that, of all the bankruptcies that had happened with municipal bonds, 95% of those were AAA rated. I don't know if that's still the case
Wow.
now. So it's like, you can't just go
There-
with the old AAA.
There's
rating.
barely any AAA bonds now at all, which is really kind of fascinating. There's,
Wow.
Stanford University papers, AAA, but there's virtually none really.
Well, Peter, thank you so much for joining us in the
No
studio.
problem.
You guys hang around. We're going to go to email time. Before I forget, though, how do people get a hold of you if they have more questions about muni bonds?
Best way is just to call me at Peter Lacour at Securities America at 800-900-6033. That's toll free, 800-900-6033.
Okay. And last week we had a special trivia contest question that we said that we were going to ask today. So,
Indeed.
first of all, let me tell you the special giveaway is going to be 2 nights at the Vichy Springs Resorts, and the Vichy Springs is the best of 2 worlds, a country inn and hot springs resort with 26 rooms and cottages that include their world-famous naturally warm and carbonated mineral baths, hot soaking pool, hold on, it's hard for me to read this, not just imagine being there, Olympic-sized swimming pool, and 700-acre private reserve for walking and exploring. Breakfast is included, as all resort activities. Vichy Springs is just 2 hours north of San Francisco and 1 hour north of Santa Rosa in the North Coast wine country. And here is that special trivia question. All right, name the 2 days of the year where no major sporting events are going on. Here are the rules. No previous winners of prizes on our show are eligible, and you must email Edward at bestofinvesting.com the answer by midnight tonight, and the winner will be chosen next week from among the correct emails we receive. And we're going to cut to our second trivia question commercial break. In the movie Shakespeare in Love, she sometimes pretended to be a man. Who was this actress? The first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In the movie Shakespeare in Love, she sometimes pretended to be a man. And who was this actress? Remember, the theme is men who played women or women who played men, vice versa. Call 888-912-1190. Make sure to include your name, your email address, and remember to speak slowly and spell out each letter of your email. And we will be right back. Great.
Awesome.
Now, do you know those 2 dates?
I
can't
don't
imagine.
know.
February the 29th, 3 out of every 4 years.
Oh, they're for the Glow Wars.
And I was invited out onto a yacht, and I looked over, and there was
Oh, how
this
exciting.
supermodel on the yacht next to me, and now I can't remember her name. She was hanging out.
Couldn't have been that super if you can't remember her name.
Oh, when I
You remembered how she looked.
Yeah, that part you never forget. It's like when we had Kathy Ireland on,
right. How many minutes on this one are we going to go to?
Yeah, we'll go about 10 and then we'll shorten up the big one.
All right.
You guys ready?
Hit it.
Let's hit it.
My low tech timer.
You know what that comes from?
Hit it.
Yeah. Where does it come from?
Isn't that Animal House?
Yes, very good. Otis Day in the Nights.
That's
Just,
right.
let's hit it.
Yeah, that's right. That's good.
Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Robert Schiff of RPM Mortgage. When we cut to the second commercial break, we ask this trivia question. Again, the theme is men who played women or vice versa. This is a vice versa one. In the movie Shakespeare in Love, she sometimes pretended to be a man. Who was this actress? Anyone?
Maybe
Gwen-
Gwyneth
Gwyneth
Paltrow.
Paltrow. Very good, guys. All right. We're going to get right into email time here. And Robert, we have a question for you. When you meet a new client, do you take a deposit to start the refinance project? This must be from someone who's ready to call you.
Well, that's a good question. I don't, and even more than that, legally, mortgage brokers are not allowed to take upfront money from people.
And why is that?
There was one of the things that happened after the default swaps and turned the market completely. There were so many abuses that the government came in and said, we have regulations now, and if you're looking to borrow money, you go to someone and they are not allowed to have you pay them money until the process is started, until you can see clearly, you get disclosures from them and find out exactly what the terms of the mortgage they're offering you.
Yeah, because at some point, you could be going through the process, and they could be wasting your time.
Yes, now the banks can still say, we want an upfront fee which will cover the appraisal, and if you don't go through with it, then they keep the money.
Well, no. So when they go through you, and you start going through the process,
I tell people if they come to me, the only money they're going to spend until the loan is done is money for the appraisal, and that'll only happen on almost all cases after they're disclosed, and we go over all the terms of what they're going to get and what they're looking at and what the costs are going to be.
And I think that's a great idea too, because there have been a lot of abuses. I know that there's still lenders out there that will charge you like a legal fee deposit, or maybe they'll send you a letter of interest and say if you want to proceed, you have to send a quote legal fee deposit or something like that. And really, it's I just think that's nuts.
well, it's too many scams out there.
Yeah, you always get the call. This is emergency. You need to call this number by the end of the day and deposit $500 to secure your. Well, we're not even sure what it secures, but no, the answer is there's no upfront deposit at all.
Okay, good. Mark, we received an email for you here that says, here's a question. Do you have any success stories about one of your clients foreclosing on a loan? Now, you have to explain what that question means. It's obviously someone who's familiar with your company.
Right, for new listeners, my name is Mark Hanf. I'm president of Pacific Private Money Loans. We are a private money mortgage broker, meaning that not only do I have borrower clients who are mostly real estate investors, that's the niche market we serve, but I also have lender clients, individual folks like you listeners out there with self-directed IRAs or savings accounts. However you invest your savings, there is an investment market known as trust deed investing, is what it's more generally called, and that's when you fund a loan secured by real estate, secured by a recorded deed of trust, hence the term trust deed investing. Again, these loans are generally here in the Bay Area, definitely in California, but mostly in the Bay Area, secured by real estate. These are short-term loans to real estate investors, many of whom may be buying property to fix and flip, so maybe it's a one-year loan, or we do have 2- and 3-year products, but generally short-term, you're not tying up your money for a long length of time. So the question was, well, what about the default rate? Has any interesting stories on the default side of things? Well, first of all, what's really interesting is that historically, a private money loan, which used to be called a hard money loan, it's kind of the softer, easier, more PC name for it today is a private money loan, but it used to be called a hard money loan. And hard money loans back in the day used to have a fairly significant default rate, 5%, sometimes higher, and if that loan is well secured, a default is not necessarily a bad thing. It just really means that, well, you're not receiving interest payments during the period of default. If you file default and go to foreclose on the property, you in theory could end up owning that property and making a much better return on your initial investment. But nowadays, most of my investors are really not interested in loaning to own, as it's sometimes called in our business. They really want to invest in this secured product, receive their 8 or 9%, sometimes 10% monthly interest yield. It's an annualized rate, but you get your interest monthly, and they don't want to have to foreclose on the property. But we did a loan 2 years ago to a gentleman, and this was a well-secured loan. He owned rental property here in the Bay Area. He wanted a cash-out loan. There was an appraisal on the property. We made him a loan equal to 60% of the value. Well, that guy promptly, within 30 days of us funding that loan, don't know what he did with the money, but he ended up getting arrested. Apparently he was running a Ponzi scheme in another venue of his life. He was collecting money from people, promising high returns. Now, the loan we made to him was a legitimate secured loan, so my investor was not at risk. But as the borrower was in jail, he didn't make any loan payments. So immediately...
Well, wait, that's no excuse. Just because he's in jail, give him a checkbook and start writing checks.
Right.
Just had to find another job while he was in jail.
Yeah, exactly.
So he missed his first payment. 30 days after the first payment, my lender instructed us to file a notice of default, which we did. That triggered the default rate of interest. So the interest that he was receiving, which was 10%, now was 14% because we have a 4% spread in the default rate of interest.
But he hadn't received it yet because...
He hadn't received it yet,
Yeah, it
right.
was just accruing at
So
this
it's
point.
accruing at that point, and late fees were accruing. So the story ended up with a happy ending because the property was put up for sale by someone, a relative, and it actually was sold within 6 months. And the happy ending for my investor was that when we put in for the payoff on that loan, known as a reconveyance, we put in for the accrued interest at the default rate, the late fees, as well as getting reimbursed for the $2,500 he was out of pocket to file the foreclosure, which we paid a third party to do that. So he got all his money back. He ended up making an annualized rate of return of over 16% for that investment. And because he was a fairly seasoned investor, he never broke a sweat.
Yeah, I was going to say, because that's almost like that's the worst news is the best news.
So now he's asking if you have any properties that might go into default.
Yeah, are there any guys who are about to go to jail? that you can borrow?
Mark, is my understanding correct? If that had gone through and he had foreclosed, then he would own the entire property where...
At 60%.
Where for 60% of its value.
Well, he would either own the property, or what happens is when you foreclose on a property, let's say there is a lot of equity, when it goes to the courthouse steps, known as the trustee's sale, you actually have to post a price, and that price would be equal to everything you're legitimately entitled to receive. So that could include late fees and default interest, etc. So it's possible, if there were sufficient equity, that a real estate investor would bid at the courthouse steps and buy that property. So you'd still get everything you were entitled to, but you wouldn't necessarily be guaranteed to own that property. So again, not necessarily a bad thing. You're getting cash. You don't end up having to take over possession of the property and maybe repair it or reposition it for resale. But
Okay, so in his case, if it would have just been normal, he would have received 10%.
Yes.
But because it went into bad territory, he ended up getting a 16% annualized
Wow.
yield.
Well,
Not
again,
too
we were,
shabby.
we were talking about bonds earlier. I mean that's one of the unique features of trustee secured loans or note investments, is that it's financing. It's not really, I mean, we call them a trustee investment, but technically it's not investing. You're really lending your money out, and the hallmark of lending is security and insurability. Whereas if you buy, say, common stock, even if you buy from Apple, and Apple's a pretty strong company, it's not guaranteed nor is it secured, so that value can still go down.
Sure.
There's not a whole lot you can do. Whereas in, well, of course we know real estate can go down, but we like to think that the air's been let out of that tire, and we're not going to see a whole lot more. And of course we'll be talking a little bit about
Tell
that.
the listeners, how do they get a hold of you if they want to get a decent yield? We can't promise them 16% because you never know if the loan's going to go into default.
No, I don't typically promise 16%, although we are, there are some creative products that some of my more sophisticated lenders like to do, and of course anybody interested in learning how you can lend your money in a secured position and make even higher than 10%, I'd love to talk about it. But my bread and butter, the most safe, the ones with the most safety and security features are first position loans, and no more than 65% loan to today's value. And anyway, you can go to my website, which is Pacific Private Investments, plural.com. That will give you information on trustee investing, pacificprivateinvestments.com, or of course go to the radio station's website, thebestofinvesting.com.
Very good. And Robert, how do people get a hold of you if they don't want to give you a deposit?
Oh, they won't give you a deposit. The best way is to call my cell phone, which is always attached to my hip, or unless I'm talking on it, which is 415-515-1941. And also you can check out the RPM website. and go to RPM website and looking for Robert Schiff.
That's revolutions per minute.
That's what it is.
We're going to cut to our third commercial break, and here's the final trivia question. This actor played Edna Turnblad, the mother of Tracy, the main character in this 2007 musical Hairspray. Who was he? In fact, I didn't even know this until someone actually pointed out to
A
me.
musical, really?
That's right, musical Hairspray. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Again, their website is lighthouse4fun.com, and that's the number 4. We'll be right back.
Was that expected or better than expected?
GDP of America is
right about in line.
something like 30% of the GDP for the entire world. It's bigger than China and Japan and some other countries put together.
Kind of interesting trivia. I was talking about low interest rates and Fed fund rates.
Yeah.
What do you think the highest rates peaked in 1981? Where was Fed fund rates then?
16.
16?
I think so.
Well, wait a minute.
19.
I was going to say that the prime one got
Oh,
up
the
to
overnight?
20 3/4.
So
That
the
part I
overnight-
remember.
I'll never forget this woman built a spec house and was trying to sell it, and I walked in on her first open house and she was telling this client, and the really good thing about this house is there's a mortgage that's assumable for only 17.5%.
That's amazing.
When I got a,
Oh my gosh.
when interest rates, industrial bond financing at 7 3/4 because interest rates were normally 13%. I go, man, I got to.
I remember when that was free money, and I was like, 7%?
Yeah.
Oh, yeah, I remember, I was a realtor. and
We
they
got-
came
talk
down
about
below
advanced-
13%.
Yeah, when talking about advanced fees, we got burned for 20 grand by a guy who came into our office and smooth talked us out of deposits for loans secured by Chinese money coming in at 7% back in the early 80s when the rates were like through the roof and
Held by
inflation
the
was
Bank of
12%.
Helsinki.
Yeah, right. He was so convincing that
Wow.
my dad literally wrote a check right then and there for $20,000, you know,
Well, I
good
had
faith deposit and
hate
Mine
that
never
stuff. I
came.
hate that stuff.
Yeah, I know.
There was a guy who came to us for a loan one time. He just showed up at the doorstep. It was the
Yeah.
funniest thing. He just shows up and you go, "Do you have an appointment?" I mean, not that we needed one, but
Right.
he goes, "Nope." He goes, "I just I heard about you guys, and I'd like a loan for $3 million." And we said, "Okay," because we do
You
we
never
do
know.
that
So far.
Right, so I think, I'm on my
I think
ears.
bag man.
I'm interested, right? He says, and here I've got $100 million portfolio.
Oh,
100 million.
100 million, okay.
And so, you know, I'm kind of looking through the papers, and I'm getting a little suspicious to begin with, right? And so we're talking, and he's explaining how he needs the money for such and such. And I said, okay, just so you know that we do, and I said, we always get, you know, personal guarantees. I said, oh, no, I can't personally guarantee, you know, I won't personally guarantee it. I said, really? You know, you got $3 million against $100 million. I said, I mean, come on, you of course you'd personally guarantee this. You wouldn't want to lose this problem. No, I can't do that. I said, see ya. I go, we ain't gonna make you that kind of loan. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Robert Schiff of RPM Mortgage. When we cut to the third and final commercial break, we asked this trivia question. This actor played Edna Turnblad, the mother of Tracy, the main character in this 2007 musical Hairspray. Who was he?
Went a long way to be Edna's mom from Greece.
That's true.
So it was
John
John
Travolta. That is
Indeed.
correct. Mark, what is going on with real estate? I know you got some good tidbits for us.
Well, yeah, you know, we like to do the story behind the story, and the headline, you know, headlines, if it bleeds, it leads. Well, the headline for last week was that, February home prices were down 4.5% year over year. Ooh, more bad real estate news. But, you know, that the news behind that is that depreciation, devaluation in real estate largely happened last year. That was really the fourth quarter of 2011. There was a remarkable decrease in both demand and pricing, but that was it. That was the bottom of the market. I mean, we have seen month over month, January, February, into March, prices are actually going up. So the trend is today, prices are going up. In fact, everybody I talk to tells me that there is a lack of supply, a lack of inventory out there, and homes on the market right now are being listed and getting multiple offers above asking. I'm even seeing that in my own neighborhood in Novato, where homes on the market last year at this time were languishing with no offers. Now every home that goes on the market has a sale pending sign literally within a week.
But they're priced right,
They're
though.
priced right.
They're
Yeah,
priced
that's-
well. They're priced correctly, but they're priced exactly where they were priced a year ago. That's the whole point.
And 20 years ago.
Yeah. So we've got so most people are or should say many folks in the business are predicting that we've seen the bottom, that we are in a price recovery. The banks are helping by not releasing a lot of REO inventory right now. So they're in many ways they're trying to create a recovery, and so people might ask, well, what about all the shadow inventory out there? But I think that they've demonstrated, the banks have demonstrated that they have a plan.
Yeah, they're not just dumping it.
They're not going to dump non-performing real estate assets on the market. So I don't foresee in my crystal ball, for as bright as that is, a triple dip. We had a dip in 09 and another dip in 11. I don't see another one forthcoming. I think we've learned the lessons of how to deal with this situation, and I think real estate's still priced so far below replacement cost that I think we're pretty safe to bet that is, at least in the short term, that we're probably have hit bottom, and we're looking ahead to go, okay, now where do we go from here?
I certainly think the market's strong. The financing is as low as it's been in decades.
Oh, mortgage rates are great.
Mortgage rates are incredible, and people are getting loans at 3.5%, 4%. The FHA will go up to 96.5% of the purchase price.
Yep.
So people are able to buy a house that many times now, with 3.5% down, they're going to end up paying, after they pay their mortgage, taxes, and insurance, and even mortgage insurance, their monthly costs will be less than the house they were renting before they
See,
bought.
that's amazing, because I still think that 3.5%, I'm going, isn't that kind of part of the problem we ran into? But the interest rates are a lot lower now than they were when...
Yeah, and talk about too big to fail. This is the federal government, so Federal
little
Housing
different.
Authority, so that's really too big
Let's
to
turn this
fail.
over to Pete for a minute. Pete, you're still in the studio here. You were mentioning about the GDP.
Just a curious, another kind of trivia. Fed funds rate is at 0 to 1/4, and it topped out at 19% in 1981. Can you
Maybe
imagine
lost his
that?
mic.
That's amazing. Yeah, I think we did lose your mic there, but that's okay. Sorry
Oh,
about that.
sorry.
I don't know what happened there. But
And that was when OPEC slammed down everything. So
yeah,
it
I
was
remember.
bad fight.
You know what? I remember that a money market money market interest rates at the bank were at 16%.
16%. Yeah, when I was in college, that's where we were all putting our savings into Franklin Money Market Fund at 16%.
Well, even the bank,
Yeah.
a regular bank was paying that. I was thinking,
And the
why-
rate of inflation was less than that, so people,
Yeah,
I know people
yeah.
were buying real estate, getting mortgages. The mortgages, I mean, that was a little before 81, were less than the rate of inflation, so.
Well, we were kind of wondering, why would people buy CDs at 12% when you can get a money market at 16? Well, it's because interest rates were about to plummet.
Mm-hmm.
In fact, I remember the old MCI getting a current yield of 19% on their bond, and the yield to maturity was around 30%. It was ridiculous.
Hey, Robert, are you seeing, in terms of the applications in the banking industry right now, has underwriting, I've heard lots of complaints about underwriting being a lot tougher nowadays. Are you seeing any changes in that this year going, we know the interest rates are really, really compelling right now, but what about people looking who still have an opportunity maybe to refinance? What could they expect?
The underwriting is as difficult as it's ever been. It's an overreaction possibly to all the stuff that went on beforehand with the no income, no asset, the liar loans. The underwriting is very stringent, and still I think it's going to stay that way for quite a long time.
So if you can demonstrate your income and you can, prove, which is, I know in the Bay Area here, that's tough for a lot of people who are self-employed. So are you able to get self-employed folks refinances or purchase money loans?
Yeah, it's not a problem if you're working and you have enough income to qualify. It's just they should be prepared for a paper chase that's more time-consuming than it was when they didn't have to supply anything.
What are timelines right now? How long is it taking to get a loan approved?
Well, RPM, I just did a deal where it's a purchase, and we promised a 20-day close. So from the time we took the application to close, it was 20 days. Now, That's not the normal. That's only for a purchase and only.
Sounds like a private money loan.
Yeah, really, that's pretty good.
This
That
is
is
a
good.
straight 30-year loan, but normally through the bank, through RPM, it'll take about 45 days to be safe to get a loan done. We had a conference with Wells Fargo yesterday, and they said they're at about 95 days in underwriting.
So are you getting a lot of requests for pre-approval, or people coming to you and getting pre-approved so they can go out and make offers on property?
Absolutely. If people are looking for property or thinking they want to make an offer to purchase, any offer to purchase almost surely has to be accompanied by a letter from a mortgage bank or mortgage broker letting the real estate agent who is representing the seller know that that client already is pre-approved, that they've already been to someone who can qualify them for the loan they're trying to get.
So the key is to do that before you start.
That's the best way to start financing.
All right, guys, thank you very much. Peter, thank you for joining us in the studio here. Here are our thoughts for the day. Get this. George Washington had to borrow money to go to his own inauguration. I guess that's where it all started. Now we're at, what, $4 trillion, right? Thank you, George Bow. And the shortest war in history was between Zanzibar and England in 1896. Zanzibar surrendered after 38 minutes. If only all the wars could be that short-lived. And with that, we invite you to tune in to next week to the Best of Investing. We're going to be giving away, how many? 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.